Something unusual happened in late January 2021. Posts appeared on Reddit calling for a silver squeeze. Within days, silver jumped from $26 to over $30. Dealers like APMEX suspended sales due to overwhelming demand. Physical silver was selling out across North America. But here's what makes this story complicated. The Wall Street Bets community itself was divided. Many members called it a distraction from GameStop. Some even labeled it a hedge fund trap. Posts warning this is a distraction gained tens of thousands of upvotes on Reddit. Yet something else emerged from that chaos, a new movement. A dedicated community that didn't go away when the hype faded. In the next 12 minutes, I'll show you what's actually happening in retail silver markets, the real numbers, the real coordination. I'm not a financial advisor. This isn't financial advice. This is market analysis based on publicly available data about an unusually small market. Let me start with numbers that deserve attention. The silver market is genuinely tiny compared to other asset classes. Total silver market capitalization, approximately $55 billion. Compare that to Apple at over $3 trillion. The entire global silver market equals roughly 1.8% of one technology stock. This size creates genuine vulnerability to demand surges. The 2021 silver squeeze attempt taught retail investors several important lessons. Let me walk through what actually happened. January 28, 2021, GameStop trading faced restrictions. Some Reddit users posted about silver being undervalued and heavily shorted by banks. The A-shares Silver Trust saw record inflows of $943 million on January 29 alone. That represented about 38 million ounces of demand in a single day. Physical dealers across North America sold out of inventory. APMEX, JM Bullion, and SD Bullion all suspended or limited sales due to demand. Silver jumped from $26 to briefly touch $30, an 8-year high at the time. But then something instructive happened. The rally faded quickly. Many Wall Street Bets members distanced themselves from silver. The mainstream forum moved on. The lesson wasn't that retail failed. The lesson was that buying paper silver through SLV potentially helped the very institutions retail wanted to squeeze. SLV is managed by BlackRock with JP Morgan as custodian. Buying shares might create more paper claims rather than forcing physical delivery. That realization transformed strategy for those who remained interested. The focus shifted decisively from ETFs to physical metal. The Wall Street Silver community emerged from this period. Unlike the broader Wall Street Bets forum, this group focused exclusively on silver. Current membership, approximately 220,000 subscribers. Not millions, but a dedicated core of investors who have maintained interest for years. Their strategy evolved to emphasize physical silver accumulation, coins, bars, and rounds purchased directly from dealers rather than paper products. The theory: if enough investors remove physical metal from circulation, eventually the paper market disconnects from physical reality. Whether this theory proves correct remains to be seen. But the commitment has been remarkably consistent since 2021. Here's what makes current conditions different from 2021. The fundamental supply picture has deteriorated significantly. According to the Silver Institute, the silver market has experienced supply deficits for 5 consecutive years. The 2024 deficit, approximately 282 million ounces. Global demand reached approximately 1.3 billion ounces against supply of just over 1 billion ounces. That's a structural mismatch. Industrial demand is the key driver. Solar panel production has exploded. Electric vehicle adoption continues growing. Both require substantial silver. Silver's industrial demand now exceeds 700 million ounces annually. This isn't speculative buying. This is manufacturers who need the metal. COMEX inventory levels have fluctuated significantly. Registered silver available for delivery has swung between 30 million and 80 million ounces over recent years. In late 2025, reports indicated rapid drawdowns from COMEX vaults. Significant portions of registered inventory were claimed for delivery in short periods. London inventories have also declined. The LBMA reported silver holdings near historic lows of approximately 827 million ounces in late 2024. These aren't retail-driven movements. This is industrial demand pulling metal out of financial system vaults into manufacturing supply chains. But retail interest adds another demand layer on top of structural deficits. And that's where the dynamics get interesting. The GameStop experience taught retail investors about collective action. Millions of individual purchases can create meaningful market impact. Applied to silver, this means understanding the difference between paper claims and physical possession. You can't halt buying of physical metal. Physical silver doesn't face margin calls. It doesn't require counterparty trust. When dealer inventory is gone, it's genuinely gone. Recent silver community activity suggests continued interest. Periodic raid days encourage coordinated physical purchases from dealers. Whether these efforts move prices meaningfully is debatable. What's less debatable is that physical demand has remained elevated since 2021. Dealer premiums over spot prices have stayed higher than historical norms. That reflects persistent retail demand for physical metal. Let me be clear about what I'm not claiming here. I'm not saying retail investors will break the silver market. I'm not claiming the paper market is about to collapse. I'm not predicting specific price targets or guaranteed timelines. What I am observing is this: a structurally undersupplied market with growing industrial demand now has an organized retail following. That combination creates conditions for potential volatility. Not guaranteed outcomes, but elevated probability of significant price movements. Historical precedent provides some context. In 1979-1980, silver rose from approximately $6 to nearly $50 per ounce. The Hunt brothers are often blamed for that spike. But recent analysis suggests their influence may have been overstated. Broader investor demand amid high inflation and dollar concerns drove much of that move. The Hunts contributed, but weren't the sole cause. Their eventual failure came from excessive leverage and regulatory intervention. When COMEX changed the rules, the Hunts couldn't meet margin calls. Physical silver holders faced no such vulnerability. Those who own metal outright kept their silver regardless of exchange rule changes. That lesson hasn't been lost on current silver enthusiasts. The emphasis on physical over paper reflects understanding of leverage risk. Current retail sentiment appears cautious but persistent, not the manic energy of GameStop's peak, but steady accumulation over years. Community forums discuss COMEX inventories, mining production data, and industrial demand trends. The sophistication has increased since 2021. Whether this translates to market impact remains uncertain. Silver is genuinely difficult to influence because supply comes from multiple sources globally. Unlike a single company's stock, silver is mined on every continent. Recycling provides additional supply. These factors create resilience. But they don't eliminate the potential for supply stress. If industrial demand continues growing while mine production stagnates, deficits will persist. If retail demand adds to that pressure, inventories will deplete faster. At some point, physical availability could genuinely tighten. We've already seen glimpses of this. Dealer shortages in 2020 and 2021 elevated premiums that haven't fully normalized. The silver market sits at an interesting inflection point. Structural factors support higher prices over time based on supply and demand. Retail participation adds a variable that didn't exist in previous cycles: the tools for coordination, the platforms for communication. None of this guarantees any particular outcome. Markets can stay rational longer than participants can stay solvent. But dismissing retail silver interest as irrelevant seems equally misguided. The community has persisted for years. The buying has continued. Silver recently traded above $60 per ounce, breaking its 1980 and 2011 highs. Whether retail played a role is difficult to quantify. Industrial demand clearly drove most of that move: solar installations, EV production, electronics manufacturing, all requiring more silver. But retail interest at the margins can amplify moves in small markets. And silver's market size means margins matter more than elsewhere. Here's what I'm watching. You can monitor the same data, all publicly available through official sources. COMEX inventory reports updated daily. Silver Institute annual supply and demand data. LBMA Vault Holdings, dealer premium levels. If deficits persist while retail buying continues, that's a tightening market. If industrial demand accelerates, that's additional pressure. These are observable conditions, not predictions. The data is available to anyone willing to track it. The retail silver movement may ultimately prove insignificant to price, or it may contribute to a historic repricing, The honest answer is uncertainty. What we do know is that conditions are different from previous cycles. Supply deficits, industrial demand growth, organized retail participation, not guaranteed outcomes, but changed circumstances that deserve attention from anyone interested in precious metals markets. The retail silver community continues accumulating. Dealer inventories continue fluctuating. Industrial demand continues growing. Whether these trends converge into something significant remains to be seen. But the pieces are in place for an interesting market. This content is for informational and educational purposes only. It does not constitute investment advice or a recommendation to buy or sell any commodity. The silver market is volatile and unpredictable. Past performance and historical patterns do not guarantee future results. The creator is not a registered investment advisor. Consult qualified financial professionals before making any investment decisions. Investing involves substantial risk, including potential loss of principal. Do your own research before making any financial decisions.